Today, we're diving into the intriguing world of dark pool trading. You might have heard whispers about it, but what exactly is dark pool trading? And how does it affect the overall market? Buckle up, because we're about to shed some light on this secretive aspect of trading. A dark pool is a privately organized financial forum or exchange for trading securities. Dark pools allow institutional investors to trade without exposure until after the trade has been executed and reported. Dark pools are a type of alternative trading system that gives certain investors the opportunity to place large orders and make trades without publicly revealing their intentions during the search for a buyer or seller. Dark pools emerged in the 1980s when the Securities and Exchange Commission allowed brokers to transact large blocks of shares. Electronic trading and an SEC ruling in 2005 that was designed to increase competition and cut transaction costs have stimulated an increase in the number of dark pools. Dark pools can charge lower fees than exchanges because they are often housed within a large firm and not necessarily a bank. For example, Bloomberg owns the dark pool Bloomberg Tradebook, which is registered with the SEC. Dark pools were initially mostly used by institutional investors for block trades involving a large number of securities. However, dark pools are no longer used only for large orders. A 2013 report by Celent found that as a result of block orders moving to dark pools, the average order size dropped about 50%, from 430 shares in 2009 to approximately 200 shares in 4 years. The primary advantage of dark pool trading is that institutional investors making large trades can do so without exposure while finding buyers and sellers. This prevents heavy price devaluation, which would otherwise occur. If it were public knowledge, for example, that an investment bank was trying to sell 500,000 shares of a security, the security would almost certainly have decreased in value by the time the bank found buyers for all of their shares. Devaluation has become an increasingly likely risk, and electronic trading platforms are causing prices to respond much more quickly to market pressures. If the new data is reported only after the trade has been executed, however, the news has much less of an impact on the market. With the advent of supercomputers capable of executing algorithmic-based programs over the course of just milliseconds, high-frequency trading has come to dominate daily trading volume. High-frequency trading technology allows institutional traders to execute their orders of multi-million share blocks ahead of other investors, capitalizing on fractional upticks or downticks in share prices. When subsequent orders are executed, profits are instantly obtained by high-frequency trading traders who then close out the positions. This form of legal piracy can occur dozens of times a day, reaping huge gains for high-frequency trading traders. Eventually, high-frequency trading became so pervasive that it grew increasingly difficult to execute large trades through a single exchange. Because large high-frequency trading orders had to be spread among multiple exchanges, it alerted trading competitors who could then get in front of the order and snatch up the inventory, driving up share prices. All of this occurred within milliseconds of the initial order being placed. In order to avoid the transparency of public exchanges and ensure liquidity for large block trades, several of the investment banks established private exchanges, which came to be known as dark pools. For traders with large orders who are unable to place them on the public exchanges, or want to avoid telegraphing their intent, dark pools provide a market of buyers and sellers with the liquidity to execute the trade. As of February 28, 2022, there were 64 dark pools operating in the United States, run mostly by investment banks. For more videos about the stock market, please check out our channel.